The stock market has long been uncertain, where fortunes are made and lost with every tick of the clock. Recently, there has been a growing sense of anticipation signaling that stocks are on the cusp of a significant inflection point. This video analyzes the factors making the stock market poised for a significant shift. By the end, you will gain top tips on navigating through this period of economic instability. There have been clear indications of economic uncertainties this year. One is the Israel-Palestine war. Kristalina Georgieva, managing director of the International Monetary Fund, IMF, aptly characterizes the war on Gaza further exacerbating global economic anxieties. The gravity of this conflict is magnified by the immense loss of life and the devastating destruction of infrastructure. You see, decimating vital infrastructure within the conflict zone disrupts economic activities and poses a significant challenge to reconstruction efforts, directly undermining the region's financial stability.
We are concerned first and foremost for the epicenter of this war, the tragic loss of lives, but also destruction and reduction of economic activity. Long-term consequences, kids not going to school today mean they won't have the skills for tomorrow.
1. The shutdown of firms' operations and their effects. Amid Israel's conflict with Hamas in the Gaza Strip, multinational corporations operating in Israel have halted their operations or implemented remote work arrangements for their employees. Leading banks such as Goldman Sachs, JP Morgan Chase, Bank of America, and Morgan Stanley have implemented remote work arrangements, enabling their employees in Tel Aviv to work from the safety and comfort of their homes. With its notable presence among foreign financial institutions in Israel, Citigroup has gone even further by offering its staff the flexibility to choose between remote work and office attendance. Adani Ports, under the guidance of Indian billionaire Gautam Adani, is vigilantly monitoring the situation at Haifa Port. Committed to maintaining smooth operations, the company has prepared a robust business continuity plan to adapt to any changes that may arise swiftly. While disruptions are unavoidable during such challenging times, shipping services have not been left behind. FedEx and UPS, recognizing the need for caution, have temporarily suspended their services and flights in and out of Israel. However, UPS has implemented diligent contingency plans, ensuring that existing shipments are promptly redirected to their intended destinations as soon as it is safe. In the health and medicine sector, pharmaceutical company Eli Lilly and Company is taking proactive measures to safeguard its employees and the continuity of medicine supply to patients across the region. In solidarity with the situation, clothing giants H&M and Inditex, the proud owner of Zara, have temporarily closed their stores in Israel until any updates are communicated.
My heart bleeds for the people in Israel that were slaughtered. My heart bleeds for the people in Gaza that now, the civilians, not the militants, the civilians that are paying such a high price. We pray for resolving this conflict as quickly as possible. The longer it goes, the more the risk of spillovers grow. And where we are as a world, we simply cannot afford more uncertainty, more hatred. We are so much into pointing fingers at each other, and we are in a world in which we need to hold hands. So fast resolution is what would help people, and it would help the world.
On technology, NVIDIA, the world's leading chip manufacturer for artificial intelligence and computer graphics, has made the regrettable decision to cancel their highly anticipated AI summit in Tel Aviv. The summit, which was set to feature CEO Jensen Huang, would have showcased the forefront of technological advancements. When global companies hit the pause button on their operations in a country, it sets off a chain reaction of consequences that can leave a lasting impact. Employees are in uncertain waters, with job security suddenly on shaky ground. The economy takes a hit, and the party gets less festive. All it takes is a disruption in the supply chain, and suddenly, everyone's feeling the pinch. Foreign investors might start checking their maps for alternative destinations, while nimble competitors seize the opportunity to swoop in and claim their piece of the pie. Communities miss out on these big players' support and resourceful endeavors, and governments scramble to plug the gap with measures that keep the wheels turning. The energy markets are heating up and causing quite a stir in the global economy. With oil prices already on the rise, the recent attack on Israel has everyone on edge, wondering if it will lead to supply disruptions and a whole lot of market jitters. Surprisingly, even though oil production doesn't seem directly affected, prices have shot up by around $5 per barrel since the conflict began. Imagine the impact if there were actual supply shocks. Energy importing countries would feel the blow, and the global economy would stumble. The International Monetary Fund warns that a mere 10% increase in oil prices could drag down global growth by 0.15 percentage points. Countries like Pakistan, already grappling with economic challenges, would have to face even more hardships. Gas supplies could also take a hit, and the pressure on European gas prices is visible. The IMF estimates a 10% surge in global oil prices could pump inflation by 0.4 percentage point globally. Should the Israel-Hamas conflict reach a point where the US and Iran are directly involved, the consequences could be severe. Experts suggest that oil prices could soar to over $150 per barrel, significantly hampering economic activity. This situation could lead to an economic downturn, potentially reducing U.S. GDP growth by 1.2% over a year. This amounts to a staggering $500 billion in lost production. With persistently high inflation and a historic surge in interest rates, the U.S. economy becomes exceptionally vulnerable to a recession triggered by the conflict.
It's a terrible human tragedy what's happening, the Israel-Gaza conflict, and we really hope there's a quick, peaceful resolution to this. In terms of the economic implications, it's a little early because we have to see how this conflict unfolds, whether it draws in other countries. What we know, for instance, is that if it turns into a wider conflict, say, and that causes oil prices to go up, that does have an effect on the economies. When you look at the numbers, suppose oil prices, say, went up by around 10%, then about 12 months later, you see inflation going up by around 0.4 percentage points. Global output is lower by about 0.15 percentage points. So it can have these kinds of effects.
The Indian stock market index has already experienced significant losses, redirecting the concerns of global markets about the ramifications of the Israel-Hamas war. This war adds to the weakening of emerging market stock indices due to ongoing global economic fragility. The surge in bond yields, reaching levels not seen since the 2007 financial crisis, signals increased inflation expectations. Consequently, it is unlikely that the Federal Reserve or the Reserve Bank of India will halt their interest rate hike cycles anytime soon. This year, investors have faced a series of challenges, and there may be more to come. While the major stock market indexes have seen gains due to a narrow slice of technology stocks, they have quickly lost ground. Bond yields have also risen sharply, with some government debt reaching over 5%. The economic outlook is uncertain, as the U.S. government has been experiencing turmoil and conflicts are spreading worldwide. According to the most recent monthly data for the S&P 500, the stock market is currently considered overpriced, with estimates ranging from 64% to 118% based on various indicators. One reason for this perception is the recent increase in bond yields, which creates competition for equities. The S&P 500, one of the major stock market indexes, finished the month of September and the third quarter of the year with losses due to concerns about the U.S. economic outlook and the potential for a U.S. government shutdown. Looking ahead, two key factors weighing stock prices in the third quarter will continue to be important this November: inflation and interest rates. Nevertheless, the current inflation levels remain significantly higher than the Federal Reserve's desired target of 2%. Although there has been a slight decline from its peak of 9.1% in June last year, the central bank predicts it will take until at least 2026 for inflation to reach its intended goal. In September, there was a month-over-month increase of 0.4% in overall inflation. This means that the general price level of goods and services, as measured by an inflation index, rose by 0.4% during that specific time frame. It indicates that prices, on average, went up slightly across various sectors of the economy during that period. The Federal Reserve has opted to maintain interest rates for now. Still, Chair Jerome Powell has emphasized the need for progress in tackling inflation before additional rate hikes can be ruled out.
We started at negative real interest rates, and we've now moved up to where we actually are in restrictive territory, but we haven't been there very long. So we believe there's more restriction coming.
2. Supply chain disruption. Looking at supply chain disruption, the material shortage is one of supply chain's most significant challenges this year. The issue arises when companies do not have an adequate supply of specific materials required for their manufacturing processes. To put this into perspective, imagine a company that produces smartphones. They require various raw materials, such as metals, plastics, and electronic components to manufacture their devices. However, due to the shortage of these materials, the company cannot acquire sufficient quantities to meet their production demands. As a result, their ability to manufacture and deliver smartphones to the market is significantly hindered, potentially leading to delays, increased costs, and even a shortage of available products for consumers. An alarming statistic from a report published by KPMG, a renowned global professional services firm, states that 71% of businesses worldwide perceive the escalating costs of raw materials as their primary concern, posing a substantial threat to their supply chains throughout 2023. 3. Performance of combined S&P 500. After analyzing the long-term monthly chart of the S&P 500 Equal Weight ETF, RSP, which represents the combined performance of all 500 stocks in the S&P 500 index with equal weighting, regardless of their market capitalization, several signals become evident. The chart reveals that RSP has recently dipped below its 3-year moving average, MA, and an upward trend support line that has been intact for the past 2 years, marked as 1. This breach of the MA and trend support line is a warning that the overall performance of the average stock in the S&P 500 may not possess the same level of strength in the coming months. This observation implies that the broader market might face challenges or experience below-average performance. The question is, will the anticipated recession ever make its grand entrance? 4. What investors should do. During economic downturns, certain market sectors tend to generate more stable and less cyclical earnings compared to others. These sectors are often considered defensive investments because they are relatively resilient to economic downturns and fluctuations in consumer confidence. Utility, consumer staples, and healthcare stocks are 3 sectors commonly categorized as defensive investments.
Our view is that by dividing the global universe by sectors gives us the maximum flexibility to manage under any market conditions. We think there's more in common between a US bank and a UK bank than between a US bank and a US pharma company, so it makes sense for us to divide the world this way.
Utility stocks refer to companies providing essential services like electricity, water, and gas. These services are in demand regardless of the economic climate, making utility stocks a defensive option for investors. Consumer staples stocks represent companies that produce and sell essential goods such as food, beverages, toiletries, and household products. These products are necessities that consumers continue to purchase even during economic downturns, making consumer staples stocks relatively more stable. And on the other side, healthcare stocks encompass companies with the healthcare industry, including pharmaceuticals, biotechnology, and healthcare providers. The demand for healthcare services and products remains relatively consistent, regardless of economic conditions, as people require medical treatment and medications. A market crash can present advantageous prospects, particularly for astute investors who can seize the moment. Despite short-term market fluctuations, long-term investors can benefit from purchasing these stocks at lower prices during pullbacks. Another investment for investors to consider in their portfolio is to think long-term bonds over short-term bonds. The difference between short-term and long-term bond yields is less significant than in 2023. As of October 25, 2023, the yield on a 3-month Treasury bill was 5.59%, while the yield on the 10-year U.S. Treasury note was 4.98%, resulting in a spread of only 0.65%. In contrast, in early May 2023, the yield on the 10-year Treasury note was 1.89% lower than on 3-month Treasury bills. It is important to note that the yield on the 10-year Treasury note has increased significantly since midsummer, going from less than 4% at the end of July. This rise in yield makes longer-term bonds more attractive to investors compared to earlier in 2023. Rebalancing investment portfolios to include longer-term bonds can be beneficial. Furthermore, it is wise to diversify your portfolio. Allocating your investments across multiple asset classes, such as real estate and commodities, can help mitigate risk and minimize potential losses. Diversification enables you to take advantage of different market conditions and reduce the potential impact of any single investment. In addition to diversifying your portfolio, implementing risk management strategies is essential. This can include setting stop-loss orders, using trailing stops, or employing hedging techniques. These risk management tools help protect your capital and limit downside risks if the market moves against your expectations. Ultimately, successfully navigating volatile markets requires knowledge, informed decision-making, and flexibility. If you've acquired a new piece of knowledge today, give this video a thumbs up, share it, and subscribe to this channel for more knowledge. Watch the next video if you're ready to be productive in life.